Part 2. Modified retrospective. Why would you do this? Why is this even in place? The idea being you're going to make the change in the current period, right? Whenever you're making the change, whatever it might be, without going back and adjusting the prior periods, right? You would just adjust retained earnings for the effect of the prior periods, but you wouldn't actually restate the prior periods. Okay, so that means like 2019 would stay exactly the same, 2020 would stay exactly the same, and 2021 would then have the change and the adjustment to retained earnings in it. How does that make sense? Well, because it kind of keeps comparability. Well, it kind of destroys comparability, but it makes the investor feel good that, financial statements aren't getting restated. Like, where are all these numbers coming from? Why are they different than what I had last year, right? Because so the numbers stay consistent in the prior years. Like, you can't touch those. Once they're stated, they are what they are. Don't mess with them. That's the thought here. And you're able to change going forward. Now, why are we doing that? It's just simply because maybe it's impractical to switch to report a change retrospectively, so we just apply the new change going forward. An example of this is switching to the LIFO method. Think about the LIFO method. The LIFO method is layers of inventory. How in the world are you creating those old original inventory layers if you've been in business for a while? I can't even imagine. So the idea is if you are switching to LIFO, then it's one of the ones that's kind of exempted, if you will, from doing a full retrospective change, because it's not feasible, right, to create those old inventory layers. Sometimes you're allowed to use the prospective when retrospective is impractical, and that's what I was just talking about, right? You're allowed to go prospectively. Hello, dog. You're allowed to go prospectively when for something like LIFO, just because it's not realistic to go retrospectively. Okay. I'm not going to worry about any more on that. All right. Let's say that you are changing. One of the things is if you are changing because the accounting standards have changed, and you're required to change the way you approach investments, right? With the equity method, that's the example it gives you here. GAAP allows you to change from that point forward prospectively. Okay, because it's, too far. All right, I had to remember where I was. Changing depreciation methods, amortization methods, or depletion methods. The idea here is it's a change in accounting estimate, as it says, that's achieved by a change in accounting principle. So in theory, it's a change in accounting principle, which means that it should be retrospective, but changing one inventory method to, one depreciation method to another, or something like that, would be counted for prospectively. I know, it's a lot. Okay. So here's an example. Change in accounting principle, that should not be reported by revising the financial statement, so not retrospective, would be a change from, and the answer is going to be B, because it's not practical to change the LIFO method. So you're allowed to treat it as a prospective change. I didn't mean to leave this one in here too. Which of the following is not a change in accounting principle usually accounted for by retrospectively revising prior financial statements? The answer for this is going to be A. Change from the sum of the year's digits to double declining balance. So the idea is that is a change in depreciation methods, and we treat it as a change in estimates, and we go with a prospective change. We change the future. And we're going to get into prospective changes in a second. The idea is that these are departures from the retrospective concept, because in theory you would think that that would be an accounting principle change, changing from one depreciation method to another, but really we treat that as a change in estimate. Okay. All right. So changing in estimates. We change estimates from the period we decide to make the change forward. We don't go back and restate anything. Right, and this is pretty commonplace because lots of accounting is estimates, and that's why it makes sense that something like depreciation would be in here, even though it's technically a change in principle. All right, but of course there should be a disclosure notes. Of course, we should say why we're doing what we're doing. So one of the places, the example they give you in the book is changing an accounting estimate for warranty expenses. How do you know? You're guessing on these things. You're assuming how many people are going to turn around and use their warranty. how would you know, right? So the idea is, what if the company determined they'd been using a 2% warranty expense and they determined that 3% is more accurate? Okay, so sales and this is right, the contingent liabilities. Yeah, sales in 2021 are 400 million. The effective tax rate is 25%, and so on. So we don't go back and fix any of the previous years. We go from now forward that we're going to go 3%. So the journal entry is simply debit warranty expense for the new amount, credit warranty liability. Nothing crazy. Okay, let's take this a step further. The idea would be you would indicate what the change was. All right, so the same data is here, but what's the after tax effect of this change? Well, the effect of the change between what we had done before and what we're currently doing, it's a 1% additional warranty expense, right? On the $400 million in sales means it's going to be $4 million change, which means $4 million more expenses, which means your net income is going to go down by $4 million. And if that's the case, then you're going to pay less taxes. And a tax rate of 25% on that $4 million, really the net effect is you will have a $3 million change, right? Because it's $4 million more expenses, so less income, but you'll pay $1 million less in taxes. So the net effect there is $3 million, right? $3 million more expenses. All right, so you would do something like put a note in the financial statement saying, hey, this is what happened. We've got a $3 million net change after taxes based on the change in our estimates. Okay. Prospective approach is usually required for a change in estimate. Okay. Change in principle we know is typically a retrospective change. Change in reporting entity, we didn't even get to that one yet, so it's not really fair to ask you that question, but it is. Correction of error. Again, we didn't get to that one yet, but let's just go with B, a change in estimate. We know that that is prospective change. Okay, another very common one, change in depreciation methods. Very common, change in estimate. Right? I mean, you're putting something in service, you have no idea how long it's going to last. But if it's a really expensive item, like in this case, a $63 million piece of equipment, if you've changed your mind about how you're depreciating that, then you better darn well update your records. So they use some of the year's digits for depreciation. I'm assuming you guys cover that in intermediate one. I don't really remember. It's been many, many years since I taught that class. But the idea is some of the year's digits, if you're not aware, is, let's say this equipment was going to be depreciated for 5 years. I think it says, useful life of 5 years. The idea with that is you've got 5 years, 4 years, 3 years, 2 years, 1 year. Add those together and you come to 15. So in the first year, you depreciate 5/15ths worth. Second year, you depreciate 4/15ths worth, 3/15ths, 2/15ths, 1/15th. All right, down to the residual value. It's easier than double declining balance, but not as easy as straight line. So and it pushes most of the depreciation up front, which is preferable very often. So anyway, I just want to kind of give you a brief explanation of some of the year's digits, or at least a reminder. Okay, so you've got equipment 63 million, 63 minus 3, right, residual value, so 60 million times 5/15, 60 million times 4/15 in the second year. So you've been depreciating this thing, you've got accumulated depreciation at this point of 36 million. Now we have decided, somewhere along the way, where to tell us, we're going to switch to straight line. Okay, so we're not changing our estimates, the amounts, the dollar amounts. We could, but that's not what it's asking us to do. It's just asking us to change the methodology, the calculation. Technically a change in accounting principle, but again, treat it as a change in estimate, so it's going to go forward prospectively. So assets cost was 63 million. The depreciation so far had been 36 from the previous slide. So that means the remaining, the book value at this point is 27 million. So we're going to take that 27 million and we're going to recalculate depreciation based on that straight line. 27 million minus the 3, right, for the residual value. So it's 27 minus 3 in the numerator, 24 million. I can't write on the screen. Divided by the remaining 3 years. So you'll be looking at $8 million in depreciation a year going forward. Totally fine. So going forward, your journal entry is just going to be debit depreciation expense, credit accumulated depreciation for the new amount, the new recalculated amount. Okay. All right, so change in reporting entity. I think I have to stop. I'll pause. We'll start in number 3 in a second.